Welcome back to Skytech-Lens. The door didn't slam, it was quietly, ruthlessly sealed in early 2025. China slapped a 10 to 15% tariff on US crude, LNG, and coal. Overnight, Chinese refiners abandoned American energy, turning to Russia, Saudi Arabia, the UAE, and even Iran. By mid-year, US shipments to China vanished, replaced by new contracts and alliances. This wasn't just a trade spat, it was a seismic reset. China ditched the dollar and rewired its oil map. American producers were left outside, watching the world's biggest oil market run without them. Years of US investment in infrastructure for Asia-bound crude were suddenly obsolete. The tariffs were just the trigger. The real causes ran deeper: currency, control, and China's vision for energy independence. The silence from Chinese ports was deafening. The rules had changed. This is the story of how the US lost its biggest customer, and why it may never get back in. January 2025. Beijing announces sweeping tariffs on US oil, LNG, and coal. Overnight, American crude is priced out, Chinese trading desks go silent, orders vanish. VLCCs from the Gulf Coast to China stop sailing. The trade halts, hopes for a quick truce fade. No back-channel deal, no diplomatic breakthrough. 90 days pass, nothing changes. US producers scramble for new buyers in Europe and Asia, often at a loss. In late 2024, US crude exports to China averaged 1.5 million barrels per day. By May 2025, it's zero. The infrastructure built for China sits idle. The entire value chain is thrown into disarray. China's motives are clear: this isn't leverage, it's a wall. The US is locked out. The impact ripples from Houston to the Permian Basin. Long-term contracts unravel. Pipelines and terminals lose purpose. US crude is now discounted to find a home. The easy sales are gone. The collapse exposes the risk of relying on a single buyer. The US-China energy bridge is gone. China proves it can pivot fast, absorbing the shock and signaling to the world it has options. American producers are left fighting for scraps in crowded markets. The lesson in geopolitics: trade can be weaponized, and commercial logic is no shield. The chapter closes not with a bang, but with tankers rerouted and contracts canceled. The question now: who fills the void? The answer comes quickly, from China's own backyard. The US is out. The world's oil map is redrawn. The great shutout is complete. With US oil out, China pivots smoothly to Russia, Saudi Arabia, the UAE, and Iran. Russian supply surges with new long-term deals, now settled in rubles and yuan, not dollars. Saudi Aramco and ADNOC boost shipments, embedding themselves deeper into China's industrial ecosystem. Iran's shadow fleet finds new life, supplying China through opaque channels. The shift isn't just about volume, it's about control. Yuan-based contracts rise, chipping away at the petrodollar. Chinese refiners recalibrate for Russian and Saudi grades. Finance teams set up non-dollar payment systems. Within 6 months, the US supply gap is filled. Oil flows reroute globally, Russian and Gulf barrels to China, US barrels to Europe. China's new oil map is politically aligned, strengthening ties with the Shanghai Cooperation Organization and BRICS. The US isn't just locked out of a market, it's locked out of an emerging bloc. The American shale revolution meets the reality of Chinese industrial policy. China holds the leverage, dictating terms and reshaping global energy flows. For US producers, it's a sobering lesson. No supplier is indispensable. The world's biggest buyer has moved on. The shutout isn't just about oil, it's about currency. China accelerates dedollarization, settling massive oil deals with Russia in yuan via CIPS, bypassing SWIFT. Beijing pressures other suppliers, Saudi Arabia, UAE, to accept yuan, offering investments in return. The Shanghai International Energy Exchange's yuan-denominated contracts gain traction. US oil, tied to the dollar, becomes incompatible with China's new system. Accepting yuan would mean currency risk and regulatory headaches for US producers. For China, using yuan reduces exposure to US sanctions and builds financial sovereignty. As more oil trade moves outside the dollar, global demand for USD could fall, impacting the US economy. For Chinese refiners, yuan pricing means stability and predictability. Suppliers accepting yuan are drawn deeper into China's economic orbit, reinforcing its central role. The US is left outside, its oil tariffed and denominated in the wrong currency. The petro-yuan is no longer theory, it's reality, processing billions in energy transactions. China's break from the petrodollar marks a pivotal shift in global power. The US isn't just losing sales, it's losing influence. The US energy infrastructure, built for China, now sits underused. Pipelines, storage tanks, and deepwater terminals face a crisis of underutilization. European buyers use smaller ships, state-of-the-art US terminals lose their edge. The logistical chain is broken, storage tanks fill up, pipelines slow, contracts unravel, owners face stranded assets and mounting financial pressure. Terminal operators scramble to market to Europe, India, Japan, and South Korea, but these markets are crowded and competitive. Redirecting supply chains is complex, costly, and slow. The industry's bet on China has backfired. Diversification is now an urgent imperative. Policy shifts are needed. Trade deals, regulatory streamlining, and diplomatic pushes for new markets. Without a breakthrough, U.S. midstream faces a long, painful adjustment. The Texas coast's gleaming terminals stand as monuments to a lost era. The U.S. is left with world-class infrastructure and nowhere to send its oil. A year passes, trade talks stall, the energy trade is a casualty of deepening U.S.-China rivalry, China's new supply chains, Russia, Middle East, are robust, UN-based payments insulate it from U.S. pressure, China doubles down on strategic reserves, filling storage during price dips. Even if relations thaw, China's need for U.S. crude is minimal. The U.S. is now a supplier of last resort. The real game-changer, China's electric vehicle revolution. EV sales soar, cutting future oil demand. Oil demand plateaus sooner than expected. The U.S. loses not just a customer but future growth. The trade deadlock becomes permanent. China's energy, industrial, and financial policies are now fully integrated. Domestic oil production rises, further reducing import needs. U.S. producers face a crowded, less profitable global market. The China premium is gone. The boom times are over. The U.S. is just another supplier fighting for market share. China's shift is permanent, diversified suppliers, UN trade, massive reserves, and electrification. The U.S. isn't just shut out, it's being designed out of China's energy future. The decoupling is structural, not tactical. The U.S. must adapt, or be left behind. Verdict, the final turn. Can U.S. oil catch up, or is the race already lost? The U.S. lost China's oil market through tariffs, contracts, and China's strategic pivot. What replaced American crude is a fully integrated dollar-free system. Even after tariffs, China's buying channels are optimized for others. The future doesn't include U.S. producers, unless Washington rewrites the playbook. The infrastructure built for a golden era now stands as a reminder of how fast tides turn. The decoupling is complete, a structural shift that will define the next decade. What's your take? Can the U.S. rebuild, or is the engine stalled? Drop your thoughts below. Thanks for watching a video, and subscribe the channel Skytech-Lens for more updates. Thanks.